Okay. So retirement of plant assets. So when we retire a plant asset, we are not getting any cash for it. So we have to get rid of the accumulated depreciation, just like we do if we sell it. We have to get rid of the asset, just like if we sell it. And then we have to recognize if it's a gain, a loss, or a wash, just like we do if we sell it. So it's the same thing if there's proceeds or no proceeds. Doesn't matter if we retire it or we sell it, we have to go through the process for both approaches. So here's an example. Assume Hobart Enterprises retires its computer printers, which cost $32,000. The accumulated depreciation on these printers is $32,000. The journal entry to record this retirement is, so when the amount of accumulated depreciation equals the amount of the cost, then it's a fully depreciated asset. So all you have to do is get rid of the depreciation and get rid of the asset. So you're going to debit accumulated depreciation, $32,000 to clear out that account, and you're going to credit equipment, $32,000 to get rid of that account. And the question on the bottom here is, what happens if a fully depreciated plant asset is still useful to the company? They can still use it. They just don't list it on the books anymore as an asset. Okay. So let's go to the next slide. Now we are going to do a problem that I'm actually going to take that slide out. That's not the right one. Okay. We are going to do a problem. I'm going to do a problem for you, not in our book. So this is one that's going to be on the slide here that you can take a screenshot of if you like, or you can pause the slide and write it down if you like. This is from the old book, but I'm going to make it a little bit bigger so you can see, because this is where we're really going to get into an example of the type of problem that you're going to get in your homework and the type of problem that you're going to see on the exam. Okay. All right. So let me read this to you, and then we will work this out. And again, you know, it's a problem that just takes a lot of steps to do. Okay. All right. So here are selected transactions for Evans Company for 2014. There's a January 1, a March 31, and December 31. So they want us to journalize all entries required on the above dates, including entries to update depreciation on assets of disposal where applicable. Evans Corporation uses straight line depreciation. And remember, everything that you'll be doing will be straight line depreciation. So January 1, retired a piece of machinery that was purchased on January 1, 2004. The cost of the machine cost $47,000 and had a useful life of 10 years with no salvage value. March 31, sold a computer that was purchased on January 1, 2011. The computer cost $43,400 and had a useful life of 7 years with no salvage value. The computer was sold for $25,000. December 31, discarded a delivery truck that was purchased on January 1, 2011. The truck cost $30,000 and was depreciated based on a 6-year useful life with a $3,000 salvage value. So we're going to do the accounting for each one and figure out how to do the process. Okay. All right. So we are doing problem 9.3b, which is not in the book. It's from the old book. When they redid the version, they took this problem out. I don't know why. It was a great problem. So that's why we're doing that problem. So we're going to work on these one by one. All right. Now, one thing I wanted to mention on the problem here is that this is for the year 2014. You're going to need that, and that's part of the instructions in the problem. Okay. All right. So we want to journalize the entries on the above dates, including entries to update depreciation on assets disposed of where applicable. All right. And then it tells us that Evans Corporation uses straight line depreciation. Depreciation is done at year end. Okay, depreciation is done at year end. So all that information is going to be important. All right. So we're going to do number 1 first. Retired a piece of machinery that was purchased on January 1, 2004. The machine cost $47,000 and had a useful life of 10 years with no salvage value. So we're doing that one first, okay? So January 1. So the first thing we need to do is we need to figure the annual depreciation. So we're going to go back over here to the steps. We're going to do step 1. Figure the annual depreciation, okay? That right here. We're figuring the annual depreciation. I'm going to make that so it doesn't take up so much room. Okay. All right, so let's figure the annual depreciation. So we have the cost, and the cost in this case was $47,000, right? $47,000 was the cost. Less the salvage. And you always write this out. Even if there's no salvage value, write it out anyways, because this is how you begin to learn the process, okay? And in this case, there was no salvage value, right? So $47,000 minus 0 gives us $47,000. And that $47,000 cost minus salvage is what we call the depreciable cost or the depreciable base, okay? And I keep saying or depreciable base because you will run into a problem here or there that'll say depreciable base, okay? All right, so we are going to look at that $47,000. Now this is where we are going to go to the next step, right? And the next step says, I'm going to copy all this over here so that we have this kind of step-by-step here. The next step says, let me get this smaller so we can see it better. And the next step says, ask is the depreciation current? So you go from the last time depreciation was done to the date of sale or the date of depreciation entry. Okay, so we're doing a sale. If there's no gap in time, it means it's current and there's no entry. If there is a gap in time, then you have to bring the depreciation current. Now, this is going to seem kind of tedious, but this is the way that you're going to figure out if it's current or not. Okay, this is kind of the process that you're going to go through to figure out if it's current or not. Okay, so we're going to start with the purchase date. And we bought this on January 1, 2004. Okay, that's in the problem. January 1, 2004. All right. We are, disposal date is January. Disposal date is, let's see, does it tell us the disposal date? Hold on a second. Oh, sorry. So this one here is not January 1, 2004. It's January 1, 2014. So we're the 2014. These are all 2014. These are all entries for 2014. What did I say? That was March 31st. 3/31. So we've got March 31, 2014. And then we have December 31, 2014. Okay, so all those entries are in 2014. All right. So we purchased it. We're disposing it on January 1, 2014. So they're making it a full year for us on this first one, just to make it easy. Okay. January 1, 2014, and I want the same format that we have here. January 1, 2014. Okay, so stick with me for a minute here, okay? All right, so the problem, so we ask ourselves, when was the last time depreciation was done? Okay, is the depreciation current? Go from the last time it was done to the date of sale. So they tell us in the problem here, depreciation is done at year end. Depreciation was done at year end, okay? And that's important because this is how you have to figure it out, right? You bought the asset on January 1, 2014, right? You're disposing of it on January 1, you bought it 2004, you're disposing of it 2014. So this is the process you have to go through to figure out if depreciation is current. So depreciation was done on the following dates, okay? Depreciation was done on December 31, 2004. Okay, because you bought it in January, so you did it in December 2004. You did it December 31, 2005. You did it in 2006. You did it in 2007. You did it in 2009, 2010. Hold on one second.